Money is a fundamental part of our daily lives. We use it to buy our morning coffee, pay for transportation, and cover our bills. It changes hands every second, yet have we ever stopped to truly understand what money is, its functions, and what it represents in terms of money demand? Don't worry about it, cause today we gonna learn money demand and interest rate equilibrium.
Money, in its essence, is any item or medium of exchange that symbolizes perceived value. In monetary economics, the demand for money refers to the desire of individuals or firms to hold financial assets in the form of money or liquid assets, such as cash or bank deposits, rather than investments. This desire stems from the need for liquidity in economic transactions.
2. We need to know what is interest rate. Interest rate is the cost of borrowing money, expressed as a percentage of the amount borrowed. It determines the interest payments made over the life of a loan. Interest rate equilibrium is achieved when the supply of money equals the demand for money in the economy. This balance is crucial for maintaining economic stability.
Next, the Fisher equation, represented as MV equals PT, explains the relationship between money supply, velocity of money, price levels, and the volume of transactions. Money supply equals M equals RM, amount of money supply. Velocity of money equals V equals how often money changes hands in the economy. General price level equals P equals RM, the average price of all goods and services that are bought and sold in the economy. Total amount of transactions equals T equals unit amount of goods and services that are bought and sold in the economy. Let's illustrate this with an example. Suppose the total money supply M is $1,000 and the velocity of money V is 3, meaning each dollar is spent 3 times in a given period. If the price level P is $5 per unit of goods, we can determine the total volume of transactions T as follows.
We will find out T equal to 600. Hence, the total volume of transactions in this economy is 600 units of goods. Now, if the central bank increases the money supply by 10% without changing the velocity of money and the total transactions, the new price level P would be $5.5.
Thus, the price level rises to $5.50 per unit of goods. This example shows how the Fisher quantity theory of money helps us understand the interactions between money supply, price levels, and the economy's transactional volume.
John Maynard Keynes identified 3 primary reasons why people hold money. Transactions motive individuals and firms need cash to buy goods and services. The demand for money here is directly related to the level of income and frequency of transactions. Higher income results in higher demand for money for transactions. Precautionary motive equals people hold money for unexpected expenses or emergencies. This demand is positively related to income uncertainty. The speculative motive for holding money to take advantage of future investment opportunities or to avoid losses from holding other assets whose prices might fall. This aspect is closely linked to interest rates. When interest rates are high, people prefer to invest in bonds or other assets. When rates are low, they prefer to hold money.
Next, we determinants of Tate interest. Bond prices and interest rates have an inverse relationship. When interest rates rise, making existing lower-yielding bonds less attractive, which decreases their prices and vice versa. So, when interest rates decrease, bond prices will increase relatively, leading to individuals and firms want to sell bonds at higher prices to hold money. That means money demand will increase. The ISLM model, representing investment savings and liquidity preference money supply LM, illustrates the relationship between the goods market and the money market. The intersection of the IS and LM curves shows the short-run equilibrium between interest rates and output. IS curve downward sloping, rightward shift, increased G or decreased tax, leftward shift, decreased G or increased tax. Next, LM curve upward sloping, rightward shift, increased money supply lowers interest rates, leftward shift, decreased money supply raises interest rates.
Next, we gonna look at the definition and principle of monetary policy. The central banks use to manipulate the economy by control of money supply and interest rates to shape economic activities.
It is implemented by central banks. Meanwhile, central bank has specific economic goals, which is maintaining stability and achieving growth. First type of monetary policy is expansionary monetary policy. It identifying ways of increasing money in circulation, used during a time when there is an economic crisis or recession, and it is employed by central banks. There are three different ways in expansionary monetary policy. First is lowering interest rates. It reducing the amount charged by commercial banks on loans. When the central banks reduce the interest rates, the consumers and businesses spend more. They capable of getting loans for purchasing valuable items. Second is purchasing government bonds. The purchasing of treasury securities and securities of other institutions will provide funds to the banking system. It brings expansion in money supply or the ability to encourage lending. This means they themselves can stockpile money by purchasing these instruments and use money for lending and spending in the economy. Third is lowering reserve requirements. It managing the ratio of cash that banking institutions must hold and facilitate banks to extend more money from deposits. Through this action, banks are allowed to decrease the ratio of capital resources allocated to normal banking work as stipulated by reserve requirements. The second type is contractionary monetary policy. It's shrinking money supply within an economy and implemented with intentions of controlling inflation or avoiding overheating of an economy. There are three different ways in contractionary monetary policy. First is raising interest rates. It will increase the interest rates on loans by commercial banks and make borrowing more costly because higher interest rates make loan payments expensive and discouraging people from borrowing or spending. Second is government securities sales. It will sell government bonds which result in taking liquidity out of the banking system and diminishes money supply and curtails lending. By trap the money, it will help in reducing money circulation in the entire economy and reducing economic activity. Third is raising reserve requirements. It increased the amount of money that they require commercial banks as reserves. By restraining their ability to lend, banks are forced to have high levels of cash through increased reserve requirements, hence decreasing funds available for lending.
There are three goals of monetary policy. Point 1. Inflation control. Contraction monetary policy prevents inflation by reducing money supply. A decrease in the quantity of money leads to a fall in demand for goods and services, lowering their prices. 2. Reducing unemployment, reduce joblessness through expansive macroeconomic management. 3. Stabilizing exchange rates, respect of the domestic currency may vary from time to time. Three tools of monetary policy. 1. Interest rate adjustments. By control the discount rate, which is short-term funds are borrowed from a commercial bank. It will encourage the people and firms to borrow more, improve the economic growth. It will increasing the rate has a positive relation with inflation, and decreases spending as a result of high borrowing costs. 2. Reserve requirement changes. It determines the amount of reserves that commercial banks must keep, used to deter or encourage a specific amount of credit, used by the monetary authorities to ensure that the money in circulation is reasonably limited. 3. Open market operations. It purchase or sell government securities to control the stocks of money. This is because the sale of securities takes much liquidity out of the market, decelerating inflation in the process.
In conclusion, the balance between money demand and interest rates is crucial for economic stability. Central banks manage the money supply to achieve an equilibrium interest rate, ensuring that money demand matches money supply. This balance helps control inflation, foster economic growth, and maintain financial stability.
Thanks for watching.